Welcome back. What you're about to hear is not a rumor, not a social media exaggeration, not a clickbait headline built on thin air. In a single 12-hour window, nearly $297 billion in silver-linked exposure moved across futures markets, ETFs, options flows, and interbank derivatives desks, triggering one of the most aggressive liquidity shifts the precious metals market has seen in years. Now, let's be very clear from the beginning. That does not mean $297 billion worth of physical silver bars were delivered to vaults overnight. What it means is that $297 billion in notional positioning, contracts, and financial flows tied to silver changed hands, or entered the system in a compressed time window. And when that much capital moves that fast in a market as structurally tight as silver, the ripple effects travel far beyond just one commodity chart. Because silver is not just another metal. It sits at the intersection of monetary hedge, industrial input, green energy supply chains, and speculative momentum. When silver moves violently, it is often telling you something about the broader financial system. So what exactly happened? Why did nearly $300 billion in exposure flood into silver in half a day? And more importantly, what does it mean next? Let's break this down step by step. First, we need to understand where that number comes from. The $297 billion figure represents aggregated notional turnover across major silver futures contracts, ETF inflows, and options activity primarily on exchanges such as the COMEX and products like the iShares Silver Trust. Notional value in futures markets is calculated by multiplying contract size by price and number of contracts traded. When volatility spikes and algorithmic funds rotate capital aggressively, turnover can explode in a matter of hours. In this case, trading desks reported a synchronized surge across futures open interest, ETF creations, and large block trades executed during overlapping US and Asian sessions. Liquidity was thin, and volatility was already elevated, and then one trigger hit the system. That trigger was not a single headline. It was a convergence. Bond yields were spiking. The US dollar was rolling over after an extended rally. Equity indices were showing signs of distribution after a prolonged run, and geopolitical tensions had quietly escalated in key manufacturing regions, tied to semiconductor and solar production. Silver, unlike gold, reacts strongly to industrial demand expectations. It is a primary component in solar panels, electronics, electric vehicles, and advanced battery systems. So when macro uncertainty collides with industrial supply concerns, silver becomes a dual threat asset, both a hedge and a growth proxy. During the 12-hour window in question, large commodity trading advisors and macro hedge funds triggered systematic buy programs. Once certain volatility thresholds were breached, algorithmic strategies automatically expanded exposure. That forced short sellers to hedge, which forced more buying, which tightened spreads, which created a feedback loop. And that is where the shock factor comes in. Silver's market structure is smaller and more volatile than gold. The gold market can absorb massive flows with relative stability. Silver cannot. When large capital enters aggressively, price moves can become nonlinear. Within hours, implied volatility in silver options spiked sharply. Market makers widened bid-ask spreads. Futures curve backwardation briefly intensified, signaling near-term tightness. Physical dealers reported increased retail inquiries. And industrial buyers began calling suppliers to lock in forward contracts. This is how a financial flow event turns into a supply chain conversation. But here's the deeper layer most people miss. Silver inventories at major exchange warehouses have been gradually declining over recent quarters. Deliverable stocks fluctuate, but trends have shown tighter conditions compared to historical norms. When financial players suddenly demand more exposure, it raises a key question. If even a fraction of that paper demand seeks physical settlement, can the system handle it smoothly? That question alone can create volatility. Now let's zoom out. Why would institutional capital suddenly rotate this aggressively into silver? One reason is currency stress. When investors anticipate monetary easing cycles, fiscal expansion, or sovereign debt concerns, hard assets become attractive. Silver often lags gold in the early phase of such moves, then accelerates violently once momentum builds. Historically, silver outperforms gold during late-cycle inflationary runs because it combines monetary demand with industrial acceleration. Another reason is relative valuation. Silver's gold-to-silver ratio has, at times, reached historically stretched levels. When that ratio compresses rapidly, it often indicates silver catching up. Quant funds monitor this spread closely. When statistical thresholds trigger, capital reallocates automatically. And then there's the geopolitical dimension. Supply chains for silver mining and refining are geographically concentrated. A disruption in Latin American production or export restrictions from major refining hubs can quickly tighten availability. Even rumors of potential bottlenecks can amplify speculative flows. What makes this event extraordinary is not just the size of the capital movement. It is the speed. 12 hours compress what might normally unfold over weeks. And speed changes psychology. When traders see a vertical move supported by huge turnover, fear of missing out accelerates participation. Momentum funds pile in, short positions capitulate, social media amplifies headlines, retail traders open leverage positions. That is how volatility cascades. But here's the critical reality check. Notional turnover is not the same as net new money. A portion of that $297 billion reflects contracts changing hands multiple times within that window. High-frequency strategies recycle exposure rapidly. However, even adjusting for that, the scale of positioning change was undeniably large relative to average daily silver market volume. So what happens next? There are three primary scenarios. Scenario 1, continuation. If macro catalysts persist, weakening dollar, declining real yields, escalating geopolitical risk, silver could enter a sustained breakout phase. In that case, dips become shallow, volatility remains elevated, and institutional accumulation continues. Scenario 2, consolidation. After an explosive move, markets often digest gains. Price may chop sideways while open interest stabilizes. ETF inflows may slow. Volatility could compress temporarily before the next directional decision. Scenario 3, reversal. If the catalyst that sparked the flood dissipates, for example, if bond yields stabilize sharply or dollar strength resumes, speculative capital can exit as fast as it entered. In leveraged futures markets, downside can be just as violent as upside. The key variable to monitor is open interest versus price. If price rises alongside expanding open interest, it indicates fresh capital entering. If price rises while open interest declines, it may signal short covering rather than new buying. That distinction matters enormously for sustainability. Another metric is ETF share creation versus redemption activity. When large funds create new shares in silver ETFs, it implies underlying physical purchases to back those shares. That can tighten real-world supply. Conversely, redemptions release metal back into the market. Now let's address the elephant in the room. Does this mean silver is entering a historic bull market? It is too early to declare that definitively. But explosive capital flows often mark inflection points. They reveal positioning imbalances, they expose fragilities in liquidity, they force repricing, and perhaps most importantly, they shift narrative. For months, many investors may have ignored silver as it moved quietly within ranges. Then, in 12 hours, it becomes the center of financial conversation. That attention alone can sustain momentum longer than fundamentals alone would justify. However, seasoned market participants understand that volatility is opportunity and risk simultaneously. Silver's beta cuts both ways. Leverage magnifies returns and losses. Emotional trading destroys capital faster than fundamentals ever will. So if you are watching this unfold, focus less on the headline number and more on structural signals. Watch warehouse inventory trends. Watch futures curve structure. Watch dollar index behavior. Watch real interest rates. Watch industrial demand indicators. Because silver does not move in isolation. It reflects the pulse of currency, energy, technology, and global risk appetite. The $297 billion surge was not random. It was a stress response in a system already primed for volatility. Whether that stress evolves into a sustained bull run or fades into a sharp correction depends on macro alignment over the coming days and weeks. In the next part of this report, we will dissect the mechanics of how futures leverage amplifies flows, examine historical precedents where silver experienced similar capital shocks, and analyze whether current inventory dynamics resemble past breakout cycles. Stay with me. This market shock is only beginning to unfold. Now let's go deeper into the mechanics, because this is where the story becomes more technical and more important. When people hear $297 billion flooded into silver, they picture vaults filling up with bars. But in reality, the epicenter of this move was the derivatives complex. Futures contracts, options positioning, swaps, and ETF share creations are the transmission channels that convert macro conviction into price movement. On exchanges like COMEX, silver futures are standardized contracts representing 5,000 ounces per contract. At elevated price levels, each contract can represent hundreds of thousands of dollars in notional exposure. When hedge funds and commodity trading advisors deploy capital, they don't buy a few contracts. They deploy in blocks of thousands. If 50,000 contracts change hands at elevated price levels, the notional value quickly runs into the tens of billions. Multiply that across multiple sessions, multiple maturities and options hedging activity, and you reach eye-watering figures fast. But here's what magnifies the effect: leverage. Futures traders don't post the full notional value as collateral. They post margin, a fraction of the contract's value. That means relatively smaller pools of capital can control enormous exposure. When volatility rises, margin requirements increase. When margin requirements increase, weaker hands are forced to add capital or liquidate. That liquidation can trigger forced buying or selling cascades. During this 12-hour surge, What appears to have happened is a volatility ignition event. A combination of macro headlines and technical breakout levels caused price to pierce key resistance. That triggered systematic buying from funds programmed to follow momentum signals. Momentum systems are not emotional. They do not ask whether silver should be moving. They respond to mathematical signals, breakouts above 50-day highs, volatility-adjusted momentum thresholds, cross-asset correlations. Once those triggers fire, execution is automatic. Now layer on top of that the options market. When traders buy large volumes of call options, bullish bets on higher prices, market makers who sell those options must hedge their exposure. They hedge by buying futures contracts. This is called delta hedging. If price continues rising, those hedges must be increased. That creates a feedback loop known as a gamma squeeze. In a relatively thin market like silver, gamma squeezes can accelerate rapidly. And because options open interest has grown significantly over the last few years, the hedging flows can be substantial. During the surge window, implied volatility spiked. That suggests heavy options demand. As volatility rose, market makers' hedging needs increased. That likely contributed to the rapid notional turnover reported across desks. But what makes this event structurally interesting is inventory context. Exchange warehouse stocks have not been in crisis mode, but they have not been in surplus abundance either. Silver inventories fluctuate regularly, yet deliverable supplies relative to open interest have occasionally tightened in recent cycles. If open interest expands dramatically while available, stocks do not. The market becomes more sensitive to physical delivery demands. Even if only a small percentage of futures holders request delivery, it can create short-term bottlenecks. Now let's introduce another layer, ETF mechanics. Funds like the iShares Silver Trust operate on a creation and redemption model. When demand for ETF shares rises, authorized participants create new shares by delivering physical silver to the trust. When shares are redeemed, physical metal is released. If the 12-hour window saw significant ETF share creation, that implies additional physical buying pressure. Even if it's incremental relative to global production, sudden demand spikes can tighten regional availability. And silver is geographically fragmented. Mining production is concentrated in a handful of countries. Refining capacity is region-specific. Industrial consumers operate on just-in-time inventory systems. That means volatility in financial flows can ripple into procurement decisions. Imagine you're a solar panel manufacturer. You see silver prices surging aggressively. You may accelerate forward purchases to hedge against higher input costs. That incremental demand reinforces price strength. This is how financial markets and industrial supply chains begin feeding into each other. Now let's compare this to historical precedents. Silver has experienced explosive capital surges before. In past cycles, when macro instability aligned with technical breakouts, the metal often entered parabolic phases. But those phases were typically preceded by long consolidation periods and tightening supply-demand balances. The key lesson from history is that silver's most powerful rallies tend to unfold in stages. Stage 1, stealth accumulation. Institutional positioning builds quietly while price remains range-bound. Stage 2, breakout ignition. Technical resistance levels are breached, triggering systematic buying and short covering. Stage 3, retail acceleration. Headlines amplify momentum, social media narratives explode, leverage increases. Stage 4, volatility climax. Extreme price swings occur, often accompanied by margin hikes from exchanges to cool speculation. Stage 5, consolidation or correction. Right now, the $297 billion surge resembles a Stage 2 ignition event. The question is whether it transitions into Stage 3. Another factor to watch is the US dollar. Silver is highly sensitive to dollar strength. A weakening dollar makes commodities cheaper in foreign currencies, increasing global demand. If the dollar continues trending lower, it could reinforce silver's upside momentum. Conversely, if dollar strength returns abruptly, it could cap gains. Real interest rates are equally important. When inflation-adjusted yields fall, non-yielding assets like silver become more attractive. If bond markets signal easing monetary conditions ahead, that environment historically favors precious metals. But let's not ignore risk. When large notional flows move quickly, volatility expands. Exchanges sometimes respond by raising margin requirements. Higher margins reduce leverage, which can cool speculative fever. If that happens during extended positioning, forced liquidations can produce sharp pullbacks. Another risk is overcrowding. If too many funds enter the same trade simultaneously, the market becomes vulnerable to sudden exits. Liquidity can evaporate quickly during reversals, amplifying downside. And this is why professional traders monitor commitment of traders data closely. They analyze how commercial hedgers, managed money, and small speculators are positioned, and when managed money longs reach extreme levels, caution increases, but the structural argument for silver remains compelling in a broader sense. Industrial demand tied to renewable energy expansion continues to grow. Electrification trends require conductive metals. Monetary uncertainty persists globally. Fiscal deficits remain elevated. Sovereign debt burdens are historically high. Silver sits at the intersection of all of those forces. The $297 billion surge may not represent new physical scarcity overnight, but it signals heightened sensitivity in the market. It signals that capital is searching for hedges. It signals that volatility regimes are shifting. Markets rarely send signals this loud without underlying tension. In the coming sessions, watch whether follow-through volume remains elevated. Watch whether pullbacks attract aggressive buying. Watch whether open interest continues expanding or begins contracting. Sustained expansion suggests fresh capital conviction. Contracting open interest after price rises suggests short covering exhaustion. Also monitor cross-asset correlations. If silver begins outperforming gold meaningfully, it often reflects increasing risk appetite within the precious metals complex. If both rise together while equities struggle, that signals defensive positioning. Everything is connected. The story is not just about a headline number, it's about what that number reveals about liquidity, leverage, macro fear, and industrial supply chains colliding in real time. 12 hours was enough to remind markets that silver is not a sleepy metal. It is reactive, volatile, and deeply intertwined with the global financial system. And when nearly $300 billion in notional exposure shifts in half a day, it forces everyone, traders, miners, manufacturers, policymakers, to pay attention. In the final part of this report, we will analyze potential price path scenarios in detail, explore what institutional desks are likely modeling right now, and examine whether this shock could ripple into other commodities and currency markets. Because events like this rarely stay isolated. They either fade quietly or they ignite something much bigger. Now, let's bring this into forward projection mode, because this is the phase where institutional desks are no longer reacting. They're modeling outcomes. When a surge of this scale hits a commodity market, risk committees immediately run scenario analysis. They stress test liquidity assumptions. They analyze cross-asset contagion probabilities. They evaluate whether the move represents positioning imbalance, structural repricing, or systemic stress. There are three broad price path frameworks large funds are likely evaluating right now. The first is the momentum continuation model. In this framework, silver has broken through key resistance levels with strong volume confirmation. If follow-through buying persists over the next several sessions, trend-following funds increase allocation weightings. In that scenario, shallow pullbacks are aggressively bought. Volatility remains elevated but directional, and price accelerates toward higher macro targets. Continuation models depend heavily on sustained macro alignment. That means real yields drifting lower, the dollar index trending weaker, and equity markets either consolidating or showing fragility. If those inputs hold, silver could transition from a short-term shock event into a medium-term uptrend cycle. The second framework is mean reversion. Large notional spikes sometimes represent positioning imbalances that normalize quickly. If price stalls and open interest begins to contract, it suggests the surge was driven primarily by short covering and tactical momentum, not long-term allocation shifts. In that environment, volatility compresses. Price drifts sideways within a broad range. ETF inflows stabilize. Industrial buyers resume normal procurement pacing rather than panic forward buying. Mean reversion is common after explosive bursts, particularly if the catalyst that triggered the move fades quickly. The third framework is volatility regime shift. This is more complex and more consequential. A regime shift occurs when liquidity conditions structurally change. For example, if warehouse inventories tighten while financial open interest remains elevated, the market becomes more sensitive to delivery dynamics. Price swings grow larger and more frequent. In that regime, silver does not necessarily move in a straight line higher. Instead, it oscillates violently within expanding ranges. Risk premiums rise, options pricing remains elevated, volatility itself becomes an asset class. Now let's examine institutional behavior. Large asset managers rarely deploy capital impulsively. They stagger entries, they hedge exposures, they monitor correlation breakdowns. If silver continues to outperform gold, some desks will rotate capital from gold into silver to capture relative beta. If silver begins correlating positively with industrial metals like copper while gold remains stable, that signals hybrid demand, both monetary and industrial. Cross-commodity correlation shifts are critical signals. Also, watch mining equities. Silver mining stocks often act as leveraged proxies for the metal. If miners significantly outperform silver itself, it suggests equity capital is betting on sustained higher prices. If miners lag while silver spikes, that may indicate skepticism about durability. Another transmission channel is currency markets. Silver strength often coincides with weakness in the US dollar. If emerging market currencies stabilize while silver rallies, it reinforces the thesis that global liquidity is easing, or at least perceived to be easing. Conversely, if the dollar rebounds sharply while silver stalls, that's a warning signal for bulls. Now let's discuss systemic implications. When nearly $300 billion in notional value rotates into a commodity complex in hours, it reveals something deeper than just enthusiasm for silver. It reveals heightened sensitivity to macro uncertainty. Capital does not move that fast without underlying tension. That tension could be tied to sovereign debt trajectories, fiscal sustainability questions, geopolitical fragmentation, or central bank policy credibility. Silver, historically, reacts strongly when confidence in monetary systems wavers. But there's also the industrial dimension. The global transition toward electrification is not a short-term narrative. Solar panel installations continue expanding. Grid upgrades require conductive metals. Semiconductor production remains central to economic growth. Silver's industrial demand profile is structurally different from gold's. That difference creates asymmetric upside potential when both monetary fear and industrial optimism align. However, industrial demand is cyclical. If global growth slows sharply, fabrication demand could soften. That would counterbalance monetary demand. So what should market participants watch over the next 2 to 4 weeks? First, open interest trends relative to price. If price consolidates but open interest continues rising, that suggests stealth accumulation beneath the surface. If both decline together, the surge may have been largely speculative. Second, ETF creation and redemption data. Consistent net inflows indicate persistent allocation demand. Sudden redemptions would signal profit-taking. Third, warehouse inventory reports. If deliverable stocks begin declining meaningfully while open interest remains elevated, short-term supply tightness narratives could intensify. Fourth, options implied volatility. If volatility remains structurally higher than pre-surge levels, it suggests the market anticipates continued turbulence. Fifth, macro alignment. Monitor real yields, dollar strength energy prices, and equity market stability. Silver rarely sustains large moves in isolation from macro trends. Now let's talk psychology. Markets are driven by narrative shifts as much as by data. 12-hour shocks create powerful narratives. Headlines amplify perception. Social platforms accelerate sentiment. If the narrative evolves into silver scarcity or monetary hedge of the cycle, retail participation may accelerate. Retail flows tend to be more emotional and more leveraged, which increases volatility. But narrative-driven rallies can also overextend quickly. That is why disciplined risk management remains critical. Professional traders define invalidation levels. They predefine position sizes relative to volatility. They avoid chasing vertical candles without structured entry frameworks. Silver's history is filled with explosive rallies, followed by equally explosive corrections. Respecting that duality is essential. Now, could this event ripple into other markets? Absolutely. Gold often follows silver during high momentum phases. Industrial metals may react if the move reflects broader commodity reallocation. Even cryptocurrency markets sometimes correlate during periods of monetary uncertainty. If capital is rotating out of bonds and into hard assets, that rotation rarely confines itself to a single metal. Watch for capital outflows from bond ETFs, weakness in duration-sensitive assets, and simultaneous strength in commodity indices. Those patterns would confirm broader asset allocation shifts. One more structural layer deserves attention. Exchange policy. If volatility remains elevated, exchanges may adjust margin requirements. Higher margins dampen leverage and can temporarily cool price spikes. Conversely, stable margin policy can allow momentum to persist. In past cycles, margin hikes have often coincided with short-term tops in silver. Not always, but frequently enough to warrant monitoring. So where does this leave us? The $297 billion flood into silver in just 12 hours was not a random anomaly. It was a liquidity shock layered on top of an already sensitive macro backdrop. It revealed how quickly capital can mobilize when technical triggers, macro uncertainty, and leverage intersect. It exposed the nonlinear nature of silver's market structure, and it reminded participants that this metal, often overlooked, can become the epicenter of financial attention overnight. Whether this marks the beginning of a sustained bull phase, a volatility regime shift, or a short-lived speculative burst will depend on follow-through data in the coming sessions. But one fact is undeniable. Markets do not move that much capital that quickly without underlying stress. Silver has now entered a heightened state of awareness among institutional desks and retail traders alike. The next moves will likely be larger than average. The swings sharper, the headlines louder. For those positioned, discipline matters. For those observing, context matters. For everyone, understanding the mechanics behind the shock matters more than the headline number itself. Because in modern markets, it is not just about how much money moves. It is about how fast it moves, why it moves, and what structural weaknesses it reveals when it does. This was not just a silver story. It was a liquidity story, a leverage story, a macro stress story. And as history has shown, when liquidity shocks hit commodity markets, they often precede larger shifts across the financial system. The next few weeks will determine whether this was a spark that fades or the ignition point of something far bigger. Stay alert, watch the data, and respect the volatility. This market shock has delivered its message. Now the market will decide what happens next.